Hello and welcome to the ACCA FIA paper, which is Management Accounting. This session looks at the very first chapter, chapter number 1, and it should be seen as an introductory chapter, but it does get into some quite detailed information very quickly. So it is a chapter that you do need to make sure you're completely comfortable with. You're definitely going to get some multiple choice questions on these types of areas, and there are certain things which, as we come across them, I'll point out to you just to make sure you are completely comfortable with how these multi-choice questions will crop up. Now, within this chapter, we're looking at how we can get information to management to allow management to make decisions. One of the first things we need to do is we need to collect data. Now, data is raw facts and figures. It will tend to be collected by the cost accountants. So data tends to be collected by cost accountants. And then this data, when they collect it, it's just a huge scutch of numbers. It's just a huge scutch of stuff which is not particularly useful in its current state. So if I was to give my managers a lump of data, my managers would not necessarily be able to make any appropriate decisions. As a for instance, you could say that if you were potentially trying to sell courses to everybody within the London area, you could say that every single person you're going to sell courses to will be in the London phone books. Giving that type of data to our managers to make a decision as to how to make the sales would not help them a huge amount. What we now need to do is we need to process that data and turn it into something which now becomes useful. That data plus the processing now gives me information. Information is something which is useful. It has a value to the organization. It has a value to my managers because my managers can now use it to make decisions. So data is not potentially very useful. However, information is useful. And we're looking at usefulness to decision makers. So the information that we would potentially process from our London phone books would be to root out all the different types of people who are potentially eligible to come on this type of course or purchase that product, and then sift them out and say, here's the new list of people that you potentially want to market to. That may now cut down your costs. So the data plus processing giving me information, that information is now useful for decision making. The information that I give my managers has to be useful for the specific decision that they are trying to take. So the information I give them has to be very specific. Also, if I give somebody too much information, then you may find that the message is lost. We call that information overload. So what happens here is I give the managers too much information such that they can't really get to the core information that they need and they can't make the appropriate decision. Too much information is bad. So too much information is bad. And too much information, that type of information overload, will now lead to poor decision making. So that type of poor decision making will then lead to poor performance. Good decision making should then lead to good performance. And as we work our way through this syllabus within this paper, you'll find that we do look at performance measurement and performance management quite keenly later on. This is why. So the good information allows for good decisions. We need to find a way to measure the performance of those decisions. Bad information will lead to bad decisions. That type of poor performance which comes from bad decisions, that needs to be changed and rectified so that in the future we can perform even better than before. Now, the cost accountants collect data. That data is then given to management accountants. The management accountants will process the data and turn it into information. So cost accountants collect data. Management accountants process data, convert it into information. That information is then passed on to managers. Managers will make decisions. Managers' decisions will have an impact upon the performance of our business. That performance will be measured by financial accountants. So that's how all the different types of accountants come together. So cost accountants collect the data. Management accountants process it, turn it into information, give that to managers. Managers will then make a decision. That decision will have an impact. That impact will be measured by the financial accountants. Now, if the information that we're providing to managers is bad, then we will always, and I do emphasize this word always, we will always have poor decisions. Bad information equals poor decisions. poor decisions equals poor performance. Therefore, bad information equals poor performance. Information is bad if it's out of date, if it's incorrect, if it's incomplete, if it's giving the wrong message to my manager. So bad information is giving the wrong message to my manager. However, that said, good information will allow for good decision making. Good information does not guarantee good decision making. So if you want to have a good decision and therefore good performance, you must have good information. That's why we say it's a necessity. So you must have good information for good decision making. However, if you have a poor manager, the poor manager will still make the wrong decision. Therefore, good information by itself is not sufficient for good performance. So good information by itself is not sufficient for good performance. You also need a good manager who can understand that type of information and then make the right decision on the back of it. So what we've got is bad information leading to bad decisions, leading to bad performance. Good information allows for good decisions, which will then lead to good performance. Now, there are certain key features of good information, and I'm afraid, guys, you need to learn these features parrot fashion. These are the type of things which come up as multi-choice questions all the time. Good information has got to, and what we say is it's got to be accurate. And this accurate is the mnemonic that we will use. And we've actually seen questions in this exam which says, as per the accurate mnemonic, which of the following is the R, as a for instance. So what we're looking at with regard to accurate, yes, it needs to be accurate, it needs to be correct. What it also needs to be is complete and cost effective. It has to be complete because I need to make sure that my manager has the ability to make the right decision. However, I need to make sure it's not too complete. If I give them too much information, that now leads to information overload. That's bad. So completeness has got a stopping point. If you give them too much, you'll end up making bad decisions, leading to bad performance. It has to be cost effective because you may end up with good performance, which gains you maybe an extra $100 worth of profits. But if it's cost you $1,000 in terms of processing to get that extra $100, you've just made a loss of $900. It's just not worth our while. So there must be a cost-benefit analysis here. And this can be quite tricky. This is something that we look at in more detail in later papers. But the cost-benefit analysis here is difficult because the cost is very easy to understand. It's the cost of processing the data. The benefit, which is the enhanced performance from good decisions, that can be very difficult to understand. Very difficult to measure as well. It needs to be understandable, and it needs to be understandable by the person making the decision. So if I was to give you a piece of information which was measured in a currency that you didn't understand, such as Klingon groats, then that makes no difference to you whatsoever. It's completely not understandable, which means it's a complete waste of time. That becomes bad information. It also needs to be relevant, and when we talk about relevance, we think about the different levels of managers. And we're going to talk about strategic, tactical, and operational managers a little bit later on within this chapter. So bear that in mind when we come to the different levels of management and different planning horizons. But relevance is really important because different managers will have different types of decisions which need to be made. Also, it needs to be accessible to the correct managers. So it has to be accessible to the person who wants to be making that decision. I don't necessarily want to make it accessible to anybody else. So you may find that there are various different types of security-based controls surrounding this information, such as passwords on files and folders to stop other people getting access to it. Also, timeliness is very important to me. I want information to be up to date or even potentially set in the future. So I want my information to be a prospective future decision. So I need my information to take the future into account. So I need to try and predict what's going to happen next week and next month or next year. Also, I need to make sure that this thing is easy to use. This also leads into information overload. And I think we've talked about that enough already. So I want to move on a little bit more. There are other features of good information which don't fall within the accurate mnemonic quite as readily as they could. However, we still need to make sure that the information that we provide is consistent, which will allow for understandability, because if the information looks the same as last year's, I'll understand exactly how to use it. I need to make sure it's communicated in an appropriate fashion. For instance, if I was going to give you a contract for maybe $3 or $4 million worth of goods, you probably want to see something written down rather than just me having a phone call with you. Also, it needs to be communicated to the right person. I need to be speaking to the person who can actually engage in that type of contract. So I need to make sure it's consistent, it's communicated properly, and then communicated to the right person as well. The communication there is one of our 5 rights, which we'll come to later on when we look at inventory management. The types of data that we have, and this again comes up as a multi-choice question all the time. There's 2 types of primary and secondary data, and then we have internal and external data. So this now has 2 different levels of types of data, which allows for 4 different sets. So what we have is primary data and then secondary data. Primary data is data that we've gathered for a very specific purpose. Secondary data is more generic data that can be used in various different ways. So primary data will include things such as, I have a very specific decision to make, I need to gather data just to be able to make that decision. Secondary data can include things such as census information from the government. This type of data can be collected internally or externally. So internally collected data can be things such as the number of units that we've produced, the amount it's cost me to produce those number of units, that type of cost accounting data that will be collected internally. External data, you may be looking at, as we said before, the government census may tell me how many people are living within a certain country or within a certain city. And what this now means is we can have 4 different sources of data. We can have primary internal data, primary external data. You can also have secondary internal and secondary external data. You need to have an awareness of this. I'm not going to give you lots of examples here, but you need to have an awareness of this and be able to actually identify them from a question. So if I said to you what type of data is a government census will be external sources of data and it will be a secondary source of data. So it's a secondary external source. If I asked you for an example of an internal primary source of data, it could be potentially the number of units that we've produced over the last 6 months, and that data will come from my cost accountants. So that internal primary source will then allow me to work out how many units I've produced. Therefore, I can now make a decision with regard to how many units I can produce in the future. So there's the predictive nature of this type of data, leading to useful information in the future. Now, there's our sources. There are various different ways that I can collect this data as well. And the problem we have is there will be a population of data, and the population of data is absolutely everything that can potentially happen. So a population is everything. It's like a universe of everything that's potentially out there. If I was to use every single piece of data, you may find that it becomes a little bit more expensive, and therefore the cost-benefit analysis says don't bother doing it. So to reduce our costs and to try to keep our information, once the data is processed, more useful and understandable, we take samples. There are various different ways that we can take samples. You need to learn the definitions of these different types of sampling techniques, because these can quite happily crop up as a multi-choice question. So I could give you a definition of one of these sampling techniques and say, which of the techniques have I just defined? That could quite happily crop up within this exam. So do be very, very careful with this. So we start off with a random sample. A random sample is where we have our entire population of data and we just pick a random number of them. So the random number of data that we collect from this population may not necessarily be representative. That means we may end up making the wrong decision. So once we process it, the information becomes quite poor. The good thing about this is it's amazingly cheap. So it's the easiest way of doing it, but it's the poorest quality of data that we're then going to collect. We then have systematic sampling, and what we say here is, instead of just picking all the data randomly, what we're going to do is we're going to pick a certain proportion of the data. So we're going to pick a certain proportion of the data from our entire population, and we'll work out how much of the proportion we want to pick, and then we will take one data sample from within that area. So if I was looking at, say we've got 100 sets of data that we need to look at, and we've decided that we're going to take 10%, I'll pick a number between 1 and 10, which is, as for instance, number 3. I'll take number 3, and then I'll add 10 and make it 13, 23, 33, etc. So that I now have a 10% sample of all of the data. That's the systematic sampling that we're talking about. In really large populations of data, you may then find you need to strata the data first. And this is where we have stratified sampling. And what happens here is the population that we're looking at is so big that we need to split it down into various different sections before we sample it. So we could be looking at things such as gender-based sampling and then age ranges. So we can split this down into various different component parts and then determine how to sample within that different component part. This is quite good because you can end up in a situation whereby the samples that you take are very representative of the entire population. However, it's very easy to make this type of sampling very biased in one way or the other. So if we, as for instance, said that we're going to have a huge population of individuals, we're going to take people who are 30 years plus and then 29 years and under, what we can then say is, well, we'll start at a sample, but if we take the vast majority of our sample from the older age range, that now makes it biased towards their opinions and their belief systems. That now means it is very easy for me to make this very biased, which is not good. In multi-stage sampling, what we have again is a very large population of data, but what we now do is we break it down into various different sections before we sample it. And the example here is usually on geographic basis, such as countries or counties and towns and cities and such. And then we take a random sample from those as well. Cluster sampling is similar to multi-stage sampling, but the samples are selected in clusters rather than randomly. This has an extra issue because cluster sampling can become very biased towards the cluster that you've decided to pick. So again, it's not very useful. Quota sampling is a number of different data sets must be collected as an objective, so we know exactly how many sets of data we have to collect at the very, very beginning. And what we do is we just go out and we collect that certain number of sets of data, and then that's the quota that we had to hit. You can actually use quota-based sampling within a multi-stage or a stratified system very, very effectively. So as a for instance, we could say that we're going to split the population down into people who are 30 years and above and then people who are under 30 years. And we can say that 60% of the population are over 30, therefore 60% of my quota must come from those over 30 years old, which removes the element of bias. That can be very, very useful to me. So that can remove the element of bias. As we're talking about data, there's an extra element which has been added into the syllabus quite recently with regard to big data. Now, big data is called big because there's such a huge amount of data collected here. Now, big data is generally collected via computer systems, and every single time you go onto a website, the website will say, we use cookies. Are you happy for us to use cookies? That's them actually collecting big data on you. And what that now means is we can identify who you are, where you've been, and the other places you've been to identify behavioral patterns. And what that now means is we can more clearly identify how to potentially try to market to you to make a sale to you. And what this now means is the computer systems that we use will collect this type of data on an ongoing basis automatically. And they collect a huge volume of data. So they collect a huge volume of data because every single time you do something on the internet, I will collect all that data. I collect a huge variety of data on you as well. And what happens here is every single different site you go to and potentially every single thing you read, because I can determine how long you spend looking at a specific page, that now means that the variety of stuff that I collect is very different from the types of data that we used to be able to collect. The velocity is all about the speed. This type of data can be collected very, very quickly. This is known as the 3 V's, volume, variety, and velocity. Now, there is another V in here which looks at the idea of the truth. We're talking about veracity. So there is a 4th V, but for the purposes of this exam, we just look at these 3 V's. So you may be asked a multi-choice question on the 3 V's as well. So be careful with this. Make sure you know what they mean, because I might give you a definition and say, which of these V's have I just defined? So that type of thing could quite happily crop up here. Now, once my data has been collected, it's been sampled, it's been processed, turned into information, that information is then given to managers. That information will then be used by managers to make decisions. And the decisions, once they're made, will be then implemented. That implementation of a decision includes planning and controlling, and then evaluation after the fact. So the performance evaluation is all about determining whether or not that decision was a good decision at the beginning. And if it wasn't, then go back and determine why it wasn't. Poor decision making is still quite good for managers because it will enhance their level of experience as long as they evaluate the performance after the fact. If they don't evaluate performance, then managers will not generate that level of experience. Good experience allows for good decision making. This is all part of the sufficiency idea. So good information by itself is not sufficient, but good information plus a good manager, that should be sufficient. They could be really, really useful together. Now, when I'm looking at managers making these types of decisions, there are 3 different levels of management that we look at, and we touched on this before. We've got strategic, tactical, and then operational. Strategic management looks at the very long term. So strategic management looks at the very long term. We're looking at potentially 15 years plus. That type of manager making that type of decision needs much bigger picture information. So he needs to have an understanding of what's happening within the external markets, within external economies. He needs to have an understanding of the bigger global picture. Tactical managers, they're looking at decisions at up to 5 years. So they will have a feeling of what's going on externally, but they need to make sure that they can deal with stuff internally as well. Operational managers look at decisions of up to, say, 12 to 18 months. So they tend to focus very heavily on internal decision making. If I'm a strategic manager, my informational needs will be different from operational managers. So if I'm an operational manager, I'm very interested in the number of people who are actually turning up for work today and how many people are on holiday or off sick. Strategic managers don't care about that. I'm looking at much bigger picture decisions. I'm looking at things such as what will be the trend in sales across global markets. So every single type of manager is looking to plan to the future, but they've got different time horizons that their decisions will have an impact across. And these different time horizons mean that each different type of manager needs different types of information. This ties in quite nicely with your accountant and business studies as well. So if you think about the different objectives that each level of management have, you can see that they all need different types of informational requirements. That now means that my cost accountant and then the management accountant needs to understand exactly who they're reporting to make sure that they collect the right data and then process it in the appropriate fashion. This now brings us back to our accurate mnemonic. So we need to make sure that it's communicated to the right person in the right way so that they can then make the right decision. Now, one of the ways that we actually plan things, and one of the things that we look at quite heavily within this syllabus, is shorter term plans, such as budgets. Now, budgets will tend to cover a period of about 12 months. They don't tend to be much longer than 12 months. When we come to look at capital budget, we will then extend that definition and say it can be for a number of years. But this idea of budgets being used as a planning tool is very important to me. So budgets from a planning perspective are critical. Also, budgets are an essential communication tool because what it does is it tells everybody within the organization, this is what we need you to do, and this is how you fit in with other parts of the organization as well. And it allows for communication of objectives and it allows for goal congruence. Now, goal congruence is about everybody moving towards the same objective. So everybody working together, not working against each other, which can happen in bigger organizations. Now, these types of budgets will allow for control. So we've talked about the idea of communication. We've talked about the idea of goal congruence. They also allow for control because what they will do here is they'll say to different departments, this is what we expect you to be able to do. Operational managers put some plans in place to make sure you can achieve these budgets. And if that now works, hopefully everything will happen and all of our objectives will be achieved. If it turns out that you're not achieving your objectives and not achieving your budgetary targets, that now means that you can take corrective action. Corrective action is our way of exercising control. So we make a decision, we then implement the plan. The plan can be expressed as a budget. If your actual results are different from your expected or budgetary results, you can now take control measures. That control measure is corrective action. So there's control being exercised by management as well. Hopefully, the plan plus corrective action should now equal good performance. All of these are key elements in every management plan and then decision and implementation. Now, within our organization itself, so within our organization, we've got different levels of management. Each different manager has different types of responsibility. And what we need to do is we need to understand what a manager is responsible for. And once we know what they're responsible for, we will then hold them accountable for the decisions that they have made. So responsibility and accountability must always go hand in hand. So responsibility and accountability must always go hand in hand. So what we have is various different types of centers. And the different types of centers that we have revolve very closely around the types of responsibilities and the types of decisions that will be made by these different managers. So as a for instance, we have cost centers. Cost centers are centers where the managers are responsible for making decisions concerning costs. The costs here will be things such as costs incurred to make a product, costs incurred to produce a service, costs incurred to help another part of the business. So our cost centers will have managers who are responsible for their costs, therefore they must be accountable for those costs. Now cost centers get split down into two different types of centers. We have a production cost center which produces an output which has external value. So cost centers are production cost centers which will produce something which has an external value. And then we also have service cost centers which produce something which has an internal value. So an internal cost center will be a service cost center, and you could be looking at things such as maintaining the machines in a different department. That would be a service cost center. You could be looking at maybe a canteen producing food for the workforce to make sure the production cost centers can make things. The next type of center we have is a revenue center. Now, if a cost center is only responsible for costs, revenue centers are only responsible for revenue streams. So I'm only looking at cash flows coming in. So cost centers is money going out, revenue centers is money coming in. Remember, responsibility and accountability must go hand in hand. Every single manager here within a revenue center will have a target with regard to revenue streams. How many sales are you going to potentially make? Your performance will be evaluated based on whether you hit that target or not. The next type of center we have is a profit center. And a profit center has a mixture of revenue streams and cost streams. So a profit center is a mixture of a cost center plus a revenue center. What this now means is you can see cost centers and revenue centers as being operational management. Profit centers become tactical management. So profit centers are looked after usually by tactical managers, our intermediate managers. Up at the top of our management hierarchy, we have strategic managers, and strategic managers will look after investment centers. Investment centers will have responsibilities for costs and revenues, as before, and how all of the money is invested. So they are looking after not just profits, but also longer term investments. Longer term investment here will also include things such as sources of capital. So should we issue some fresh shares? Should we issue a new bank loan? Should we have a new type of convertible bond? Should it be an unsecured bond? All of these issues will be dealt with when you come to your financial management paper. So the investment center sort of moves in a slightly different direction. We tend to focus quite heavily at the very beginning of these papers at cost center level and profit center level. So cost center level and then profit center level. So we cover profits, we cover revenue streams, we cover costs as well. We don't tend to focus too heavily on the investment center. There will be one chapter which looks at investment centers, which is when we start looking to extend our budgets beyond a 12-month period. Hopefully all of that has made sense to everybody. This is an essential foundation chapter for the rest of the syllabus. Do go back over this a couple of times to make sure you're happy with some of the terms I've been using, because we will be using these terms again in later chapters. So make sure you're completely happy with all of this. The questions here, there's not a huge number of questions on the online question bank, guys, but the questions here are essential because it does ensure that you do still have that foundation knowledge before you move on. So do make sure you have a go at all those online questions. Apart from that, thank you very much for your time and attention. I'll see you all on chapter number 2.